Hey guys, how's it going? It's Andy from Magoo Investing. Welcome back. In this episode, we're not going to be talking about a Robinhood Top Stock today, actually. I thought since we had a long weekend, I had some extra time to do some research. And so in this video, we're going to be talking about what it means when a company goes public and what it means as a shareholder to own stock in a company. So I think it's really important that it's pretty well known that, as you get older, you start getting some more money, you put money into investments into stocks. And I think it's important that before you start doing that and start putting a lot of money on the line, kind of understanding what it means for a company to be public and the rights that you have as a shareholder. And before we get started, I gotta say that I'm not a licensed financial advisor and I highly recommend talking to a professional. Someone can find you the best places to put your money going forward. In addition, I really appreciate if you hit that like and subscribe button, as it would help my channel out a lot. So if you kind of just sit there and think of some of the most well-known companies out there, most of the ones you think about are publicly traded companies. Stuff like Apple, Amazon, Google, Microsoft, that stuff. And those are all publicly traded companies. And it just kind of assumed that some of the largest companies are public, but that's not true. There are many companies that are still private. And in this video, we're going to be talking about some of the pros and cons about being a publicly traded company compared to being a private company. And so first off, let's talk about the largest pro about going public. And that's pretty obviously the fact that there's a great monetary value with going public. And so what going public means is that you get a valuation of your company and you sell shares to the public. And so this is a great way of raising money. As a private company, you have options on how to raise funds, but they're a lot more limited. Stuff like getting a bank loan, money from the owners or people in the company, and then stuff from venture capitalists. And so in times when venture capitalists aren't spending as much money, sometimes the best option is to go public because it's an easy way to acquire funds. Two of the most common examples of IPOs have been tech companies and biotech companies. And kind of the main reason for this is that these two industries have been known as being cash burners, meaning that they spend a lot of money before they eventually become profitable. And so for companies like this, it's extremely risky. And when there's a lot of risk, it's a lot harder to get loans and venture capitalists to back the company. And so becoming a publicly traded company is a great way for the company to raise funds to try to expand their business before eventually, hopefully, becoming profitable. And so one of the biggest crashes in recent memory has been the dot-com boom and eventually the dot-com bubble bursting around the year 2000. And basically what happened was a lot of money was being spent into tech companies and dot-com companies that the investors didn't know a lot about. And so there was kind of an over expectation on how well these companies would perform. And so it pushed the stock market really high, and there were so many tech companies that were IPOing on the stock market. And so there was a lot of money that was getting poured into these companies, and a lot of them, when the market fell, lost a lot of their money because as a publicly traded company, your market cap is directly related to how many shares are available and the stock price. And so when a stock falls, you're losing a lot of your available funds. So now let's talk about what an actual share means. And as you'd expect, it means that you're owning a share of the company. And so me owning one share of Apple doesn't really mean a lot. But when you take a look at some of the largest investors out there, for example, Warren Buffett with Berkshire Hathaway, he currently owns 250 million shares of Apple. And so that seems like a lot, but what does that really mean? And so if you look at the total number of outstanding shares and you put Warren Buffett shares over the total number of shares, that shows how much of a percentage of Apple Warren Buffett owns. And when you do the math, it ends up being around 5% of the company. So Warren Buffett, with his company Berkshire Hathaway, currently owns 5% of Apple. And so that seems pretty nice for someone that has a ridiculous amount of money. But what does that mean for an actual investor, someone like me that only owns between 10 and 50 shares of a company? And so on this channel, I've talked a lot about IPOs and kind of my reasoning for staying away from them. And so let's talk about the IPO process. And so when a company is getting ready to IPO, there's a lot of regulations that it has to go through, a lot of forms that it has to fill out with the SEC. And so after it passes all those things, you get an outsider that comes in and evaluates the company and basically gives a dollar amount for how much they think the company is worth. And based off of that, the company can sell shares at whatever price that they want. And so the way you kind of look at that is you get the valuation and then you divide it by how many shares they want to sell. And so this past year, Uber was valuated at around $75 billion, and they decided to sell $180 million worth of shares to the general public. And so when you sell them at $45 times 180 million shares, that ends up being around $8.2 billion that was acquired by the company. And so that's a great way, or a great example of the cash flow benefits of selling stock in a company. And so I mentioned that Uber was valuated at $75 billion. And when you looked at it, that was only $8 billion worth of it. So where's the rest of it? And so this kind of introduces the idea of the amount of shares that are sold aren't the total amount. And so the total amount of shares sold in this instance was 180 million. And so while this is not, that was the number of shares that were sold in that instance, the total number of shares were sitting around 1.7 billion. And so when you take 1.7 billion times the $45, that's where you get the valuation of around 75 billion. All right, so now we've kind of talked about what it means to IPO, what the share price means, and kind of what it means as a whole. And so now let's start talking about the rights that you have as a shareholder. So one of the easiest ways to think about being a shareholder is your ability to increase the amount of money that you put in based off of the success of the company. So if I bought Uber shares at $45 and it goes up to $50, you're benefiting from the company doing well. But since Uber has not done well, you'd be losing money. So this is where the risk and reward comes into play. If you take a position in a company that's more risky than others, you have a higher chance of making a lot of money, but you also have a chance of losing a lot of money. And so being a stockholder means that you increase your value as the stock goes up and you decrease your value while it goes down. In addition, for stocks that give out dividends, you're entitled to those as well. So in addition to making money or losing money off the stock, you also have the right to vote in important decisions for the company. So I'm going to throw up on the screen right now an email that I got when I was holding Roku shares last year. And basically it brought me to a website and had me vote on important decisions about the company. This can be decisions whether to sell more shares to the public, to remove someone from a position, or just general other important decisions about the company. And so while I may only have held maybe 10 shares of Roku, for someone like Warren Buffett that held millions of shares in a company, he gets a lot of votes. And so that's where the percent owned of a company comes into play. And so while my vote may not seem like a lot, you have the right as a shareholder to vote in these decisions. In addition, being a shareholder gives you the right to listen to the conference call about the earnings. And so earnings have kind of been something I've talked about on this channel as something that's very frustrating for me, where the number that's reported for earnings doesn't exactly dictate what the stock market does to it overall. And so listening to these earning calls, it gives you a better understanding of where these market moves come from. And so in these earnings reports, you can learn a lot from what they say. In addition, you can learn about how they say it. And so when a company has these earnings calls, they talk about their financials for the quarter, and they also talk about their predictions for the upcoming quarter and the next year. And they talk about kind of the state of the company. And so for a company that does decent in this quarter, and then the CEO may come out and say something like the tax or the tariff implications from the China trade war may negatively affect their company, and that may push the stock down. And so earnings isn't just the number, it's kind of the way that they say it and the extra information that they give. In addition, as a shareholder, you're allowed to listen to these conference calls and you're allowed to call in with your questions. Most likely you're not going to get those questions answered, but in my experience, sitting there and listening to the company talk about how they've been run and answering other questions, it's a great way to get a better understanding of how the company is run. And I highly recommend anyone that has a long-term position in a company should go back and listen to these earnings calls if they can. And so let's talk about finally the cons about being a publicly traded company. And one of the most common ones is the fact that they have to deal with the SEC, the Securities and Exchange Commission. While a company has to own at least 51% of the shares to be the majority owner, even though they have a majority of the shares, they still have to listen to what the minority has to say. And so when you're a publicly traded company, you don't have as much freedom in deciding how your company is run. In addition, you have to make decisions that will be beneficial to the shareholder overall. And so as a publicly traded company, you're not as free to make decisions about your company. You have to wait and have important decisions go through the shareholders. You have to make them all public information. Whereas as a private company, you can make whatever decisions you really want, as long as your board members and the people in charge agree with it. Being a publicly traded company, there's a lot more hurdles that they have to go through to make decisions. So overall, a public company has to disclose their finances, their plans, and just kind of give an overview about how the company is being run. And so there's definitely pros and cons to being a publicly or privately traded company. And while there have been a lot of examples of companies going public, recently we've had Uber and Lyft in the past year, there are plenty of examples of companies that have been publicly traded, buying back all their shares and becoming private again. Some of the examples I think of are Panera and Burger King, where they're now privately traded companies. But overall, currently, most of the largest companies in the world are publicly traded. As I mentioned, the benefits for financial gain and just the ability to expand because they have the availability of this money. And so as we talk about investing on this channel, I thought it was really important to kind of break down what it means to own a position in a publicly traded company and the rights that you have as a shareholder. I think at this point it's just generally understood that as you start gaining more wealth, you need to start investing in companies. But I don't think enough people kind of sit down and understand what it means to be a shareholder in a company. So I thought this video was an important idea to go over, and I'll be back to discussing individual companies in the next video. So if you have a video or just an idea like this you'd like me to go over in a future episode, please leave it in the comment section down below. If you like this video or if you learned something, I really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. Thanks for watching this video, and I'll see you in the next episode. Thanks for watching.